Hello and welcome to the latest investment market update. I hope that you're all keeping well. I'm Brian Moorman, Chairman of Brunsdon Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald, of course, have been carefully selected to manage the Brunsdon investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. Today, we're taking a deeper dive into why certain funds are selected within our portfolios. Mark, let's start with the healthcare sector. Could you cover why Polar Capital Healthcare Opportunities has been chosen?
Yes, of course. When we're looking to select funds, we obviously have a basic sort of process in place to whittle down suitable options for our portfolios, which applies pretty much across every single asset in all of our portfolios. And we'll look at things like quantitative analysis, we'll look at things like risk scoring, we'll look at things like return scoring, things like that, in order to create a shortlist, if you will, of funds that we feel, or assets that we feel are appropriate to our portfolios. We'll then go on to the next stage, which would be things like interviewing the respective managers of those products, and making sure that we're comfortable with what they're looking to do, and that process and approach fits in with what we want to achieve in our portfolios. So in the case of the Polar Capital Fund, we were looking for a product that would differentiate itself from the index. Clearly, we can track the index using a tracker very cheaply. So we want something that is doing something a little bit differently, but also is providing a strong risk-adjusted returns when looking at that benchmark as well. So the Polar Capital Fund specifically has a very long track record. The manager of the fund has been running the fund for a long period of time. We've had a good relationship with him for a number of years now. And the approach that he adopts is one essentially that will look to get positions in some of those large companies that are dominant within trackers, but also look to invest down the market cap. And he'll sort of put different sort of levels of filters in terms of which companies he's willing to select in order to try and create a portfolio that is composed of the best companies within the healthcare space globally, that also aren't sort of the riskiest positions, because clearly, especially in the world of healthcare, there is a lot of capacity for companies that may be on the cusp of delivering some sort of super drug or whatever it may be, but actually that sort of position is very, very risky indeed, and that's not the sort of approach that we want someone to take. So it's all about those risk-adjusted returns, to create a fund, an asset that has a good mix of companies essentially across the market cap piece, rather than just a replica or something that will just essentially do something very similar to a tracker.
Okay, thanks, Mark. Thinking about technology, of course, that's been very much in the headlines of late. So why AXA Framlington Global Technology Fund?
It's a very similar story with the AXA Framlington Fund, if I'm honest. Again, this fund is one that, yes, it does have exposure to some of those larger companies, but again, will invest down the market cap into slightly different areas that are very difficult to replicate or represent within a tracker in any meaningful way. So this fund, again, will look to go to parts of the market that trackers are not able to go to so much. And again, it employs a similar sort of overlay when looking at companies that it wants to add into its portfolio. This is a particularly interesting one at this point in time, because actually the manager of the AXA Framlington Global Technology Fund, Jeremy Gleeson, has actually just left AXA Framlington. So when that happens, we don't automatically sell the asset, but we do sort of kind of monitor it even closer. We meet the new manager, who is a chap called Tom Riley, and we will continue to look at that product. And obviously, if for any reason we become uncomfortable with new management of a fund like that, then we would not hesitate to look elsewhere to move our assets. I'm not saying that that is what we're going to do with that fund. We're quite comfortable with things are at the moment, but I think it's a good example of, yes, once we've selected those funds, we will monitor them and we will keep on top of what's going on in them very closely. And if anything changes with regards to their approach or outlook or anything like that that is not in keeping with what we want the fund to achieve, we won't hesitate to move away from it.
Okay, Mark, talking about possible movements within the fund, of course, you've recently selected the T. Rowe Price US Smaller Companies Fund. Can you give us an overview of why you've done this, please?
Yes, this fund, again, is quite an important one, I would say. Traditionally, when looking at US markets, active fund management tends to struggle. You tend to find that active managers in the US don't outperform the index. So a slightly traditional view is, if that's the case, why would you pay extra for an active fund manager when you can just buy the index cheaply via a tracker? However, in the case of US smaller companies, it's very much worth bearing in mind that roughly a third of the Russell 2000 companies, which is a small cap index in the US, roughly a third of those companies are unprofitable. And actually, if you just buy the index over a longer period of time in the US, you are quite exposed to a large number of companies that frankly aren't making any money. So in this case, in a bit of a break with the sort of more traditional view, as it were, we feel that active management is appropriate in order to allow a manager who's on the ground in the US, who knows these companies very, very well, and will avoid getting exposure to these unprofitable companies that we don't really want to have in our portfolio, and will therefore kind of be able to actively pick those stocks that are more appropriate for what we're looking to achieve. Unlike the Polar Capital and the AXA Framlington funds, you'll find that the T. Rowe is, has a larger number of holdings. I think it has around about 150 to 200 holdings on average. The other two funds are more like sort of 45 to 50. So it is a much more kind of broad fund, which is more reflective of the index. But as I said, those positions that it takes are core profitable companies within the US smaller company space, and it will not include those unprofitable positions that, again, we feel add an undue level of risk within our portfolios and is not really what we want to be focusing on when we're putting our assets together.
Okay, thank you, Mark. And indeed, thank you for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.